I'm in the M1 Finance account that I was using for my inflation alpha strategy, which I started several months ago, back at the beginning of April 2022. And right now it's got a current value of $13,150.67, representing a loss of $514.81. I had basically forgotten about this strategy and forgotten about this account since I created it several months ago. I guess, what is that, 7 months ago at this point? And that is not good because I had a quantitative strategy behind the holdings in this account. Basically, there was an exit point that I was supposed to exit all of my holdings at. So what holdings did I have in this inflation alpha strategy? We'll talk about that, and then we'll also talk about the strategy itself and kind of review the performance. So even though I really botched this one, and I did not follow the strategy because I forgot about it, which is one of the problems with quantitative strategies and active management, right? It's like you might get something that in theory should work out good, and it might work out good, but if you botch it and totally forget about it like I did here, well, it doesn't work out so good. Anyways, for going bad, this did not go horrible. So let's discuss it right now. The inflation alpha strategy. What are the holdings? Well, in this video, I did this video investing $10,325 in this quantitative strategy to crush inflation. And I think I have another video in here on inflation. Basically, what my research was showing was that there were 4 asset classes that typically do well during inflation, but in different types of inflationary environments, one does better than the other, right? There is no single inflation alpha asset. Like, for example, a lot of people say gold is the best asset class for inflation. But, well, if we take this chart right here and we just look at it, let's just put it year to date 2022, we can see gold, which is represented by the ETF GLD, is down 4.5% almost on the year. So, it has not done well in this regime of inflation that we've had. In other periods, gold did great, right? So the asset classes do vary, but there's 4 asset classes that tend to all do pretty well during inflation, and they are, I've got them held here, U.S. real estate. You could probably expand this broadly to global real estate, but for the sake of research, it was just U.S., and that's what I'm holding. Energy as a sector, United States Commodity Index, broad market commodities, and then gold. So those 4 asset classes, being real estate, commodities, gold, and energy stocks, all tend to do well during inflation, but again, we really don't know which one the best is. So my strategy was based on holding an equal weighted basket of those, equal weighted by 4 assets is 25% each, while we're in an inflationary regime. Now, how do we know that? Okay, for that, let me just see if I can pull it up in this video. There was a little bit of backing by Ray Dalio's theory of economic climates. So I'd kind of illustrated it right here, right? There is inflation when you have higher than expected average, or higher than expected or above average inflation, and then deflation, which is really not deflation, it's just lower than expected or lower than the average inflation. Okay, so you have those scenarios, right? Now, how do you ultimately know when you're in each one? Well, the flip side of these asset classes, and these 4 asset classes as an aggregate do well when you're in an inflationary environment. The flip side of that would be in a deflationary environment. Bonds specifically, and what we're going to use as a proxy, or what I used as a proxy, or 10-year treasuries, tend to do well. So how do we know when we should be in each one of them? Well, I was going to use a simple relative strength metric, which is this 6-month total return. Okay, so if we were to look at this in terms of a monthly strategy, which I ultimately made, basically if the 6-month total return of bonds, 10-year treasuries or intermediate term treasuries in this case, is higher than that of the aggregate basket of inflationary assets, which I've got here, the real estate, energy sector, commodities, and gold, we would, in that case, for that month, move into intermediate term bonds or intermediate term treasuries. If the aggregate total return of that basket was higher than the bonds, we would stay in or move into those inflationary assets, right? And in the broader scope of my portfolio, this would fit in when I was not holding equities for a particular strategy. We're not going to get into that in this video, but the thing you should take away is if the 6-month total return of the bonds was higher than that of the inflationary assets, we would go into the bonds. If the inflationary assets had a higher total 6-month return, we would go into the inflationary assets. And I would check this each month. Now, basically all year, it has been in these inflationary assets. So I started the strategy on basically around the time I published this video. I started it on April 1st, 2022. And at that time period, prior to that, the aggregate of the inflationary assets was higher than that of 10-year treasuries or intermediate term treasuries. And I've got these all pulled up here on Morningstar. So we've got VFITX, which is the intermediate term treasury mutual fund by Vanguard. We've got XLE for energy sector. These are ETFs, by the way. USCI for commodities, GLD for gold, VNQ for real estate. So if we roll this back here, let's just go back to what I was looking at when I would have started this. 331, and we're going to want to go to 1130, maybe December, yeah. December, November, March. Still have to count these things out on my fingers. Okay, so if we basically took the total return of these inflationary assets, and we can just do this with a simple calculator here by saying that by adding up 43.28, the total 6-month return for energy, 6-month return for commodities would have been 36.25. Gold would have been 7.49, and then real estate 3.15. Divide that by 4. As a portfolio, you'd be up 22.5%. So clearly that's more than the intermediate term treasuries, which are down 5.26%. As of looking at this on 4/1/2022. So here for our signal, we are going to go into the inflationary assets, and that's what I did. I created this portfolio on M1 Finance, equal weighted them, made my investment, which I think my investment was, what was my investment? $13,536. I don't think I did this all at one time. I did like $10,500 the first time, then like another $3,000 roughly investment a few weeks later. All right, but at this time, the signal is clear. Inflationary assets is where the momentum is. This is fundamentally a momentum or relative strength strategy. You could describe it as either one of those. Momentum would typically be used to describe, or would in theory have some other metric in there that's not comparing it to other ones. I would say that relative strength is kind of like a subset of a momentum strategy. So anyways, you could call this a momentum strategy or a relative strength strategy. You're not going to get knocked either way on that. Anyways, going back to this, where was I? Okay, so the exit point for this would be when the total return of this basket of holdings is lower than that of intermediate term treasuries. So we actually hit this point, and I totally missed this, with the beginning of October 2022. So we set this to September 30th, 2022, and then the ending point, which would be 4 months before that, or 6 months before that, excuse me. So that would be March. Or the end of March, I should say. March 31st, year 2022. Right? If we were to add up the returns of all of these assets, divide by 4, and get a return on the portfolio, it would be less than that of 10-year treasuries. So you're down 3.76%. Let's just make sure that goes negative. Or any of these positive? No. Let's go 0 minus 3.76 for starting this, or negative 3.76 minus 6.78 minus 14.1 minus 24.76. Divide that by 4 of them. The portfolio itself now over the last 6 months is down 12.35%. That is down more than the 10-year treasuries. So for October 1st, I should have exited my position in this portfolio, but I did not. I continued to hold. Now, fortunately for me, that actually worked out really good, as basically everything came back up, particularly real estate and I think gold or maybe commodities. We'll see. All we got to do is just toggle this to today's date, which is September 29th. And well, energy really sprang back up, and we can see everything just springing back up with energy. Real estate also came up there, gold, and then commodities up a little bit, but not so much. Anyways, this caused my portfolio to really recover, even though I botched things. So where does this leave me overall on the strategy? In other words, how do I feel about it? Was this good? Was this bad? And what do I learn about this going forward? Well, number one, the big thing I learned is if I'm going to do this, I have to follow it and monitor it. And usually I would do this in my account, in one of my other brokerage accounts that has other invested capital in it. And I'm looking at that more frequently and regularly. Here I invested it, using M1, which is nice, but subsequently it was not something that I'm regularly following, and ultimately forgot about it. Again, that didn't work out so bad for me this time. But bigger picture on the strategy in relative strength in general. Well, first thing is we have a very small sample size. I will be checking it again not tomorrow, but 2 days from now, November 1st. Or actually, I'll check it at the end of the day tomorrow after markets close and see what my signal would be. The signal might be over the last 6 months that I should still remain in this inflation alpha strategy. And in that case, I will keep my position. But longer term than that, this is still a very small sample size. Now, I started a little late here, right? So if we extend this back here, right, inflation was rip-roaring up before this. It's going to go 3 years, but we'll just go back a couple years. Back to the glory days of COVID, we can see that commodities and energy just started rip-roaring up in early 2022, but I didn't start until April. So, I missed a lot of it there. And even through 2021, they were also rip-roaring up here, right? So, there's a couple things that I'm seeing here, and that is, there's one thing that just popped out of my mind. I'm not going to go to that right now because that's kind of a side thought, but basically what I'm saying here is I had a very short period of time that I was actually in it. And this does fit into my larger portfolio in a time when I exited my equities. And that is, I exited a lot of equities, not all of them, but a good bit of them via one strategy on February 1st. Okay, so had I done this 2 months earlier, my returns would be a lot better. Right? So let's just look at this. Let's just say, hey, had I had followed this strategy when my signal was moving me out of equities, and into alternative assets, how would things have done? Right, so if we go in here, and then let's say I still followed things to a T and exited October 1st, well, here's where I would have ended up. And let's just do the math and add this up. We were at up 8.83% with energy, up 7.94% with commodities, down 7.36% with gold, down 22.56% with real estate. So down 13.51, excuse me, that's not accurate. We need to divide by 4. Only down 13.28%, or excuse me, really botching the numbers here. Only down 3.28%, whereas at this time, 10-year treasuries are down 9.72%. So fundamentally, the strategy did provide some outperformance there had I started at an earlier date. So if I'm going to continue this, I need to work this in with my quantitative strategy and also move into the position, in and out at that time. And I think I would have done quite a bit better here. Or not quite a bit, but I actually would have had a little bit of outperformance. The other thing is, what if we looked at this big picture and said, hey, what if we replace this strategy for a fixed income, for the fixed income portion of your portfolio, right? Like, let's just say you're 40% bonds and you use this consistently. Well, in that case, you probably would have caught, or you not probably would have caught, you would have caught the trend a lot earlier and stayed in it. So for me personally, how this fits into my portfolio is, when I exit equities, and the signal there is for me to really scale down my scale down and exit my equities. I should go into this still. And not only that, but B, if you are a holder of fixed income and bonds, possibly this could replace just your static allocation to bonds. And we can see here, I'm not going to go back and toggle it on it here, but probably sometime around the end of 2020, you would have gotten into the commodities. And let's just see. Actually, you know what, for fun, let's just go back to 12/31/2020. And we'll go 2020. Should be 7/1. Yeah, right. So here at this point, would this have signaled to us to get into the inflationary regime assets? And yeah, this is definitely it would have with the performance of these. So then, that said, you would be basically in these from 1/1 until October, until October. So we want to go September. There you go. So at this point, you would have, if we wait these out, you probably would have had close to a 45% return in commodities as opposed to staying in bonds for that portion of your portfolio. So possibly this should exist as a standalone strategy for your bonds and lower risk. I shouldn't say lower risk, but for your bond portion of your portfolio, or as an alternative to just holding fixed income. Because one thing we've seen here over the last couple of years in particular is that bonds don't always go up. Bonds can have some drawdown. So guys, that is, I think, a wrap on this video. Even though for the sake of making a video for YouTube, the strategy did not look good, I still like the strategy as a relative strength strategy between bonds and commodities, or otherwise expressed in terms of economic climates, inflationary and deflationary economic climates. What are your thoughts on this strategy, guys? Let me know in the comments below. And hey, if you found this one helpful and insightful, be sure to do me a sweet one and hit the like button, and do yourself a sweet one and hit the subscribe button. I'm signing off on this video.